Sorry, I was on mute. I didn't notice. Thank you, Arthur. I was welcome you everybody for to this event from the Center of Portuguese Studies. I would like to thank your presence and the presence of our special guests, Arthur Guimarães from UC Berkeley, Dolat, Carim Habib from the Dolat capital, and my colleague Deolinda Adão. I would like to thank you all for this. This is an event in collaboration with the FLAT. If you have some questions, please put it on the chat, and Deolinda will make sure that those questions get to our special guests. Thank you again, and I hope you have a good session. Deolinda.
Good morning, everyone. Thank you for joining us this morning. I know we're 1 hour earlier than we usually come on, but I appreciate your presence. With the time change, we're all a little bit mixed up with hours, but I hope we'll be able to have this time slot be as successful as usual. Today, we're very happy and very proud to have two excellent guests, and I will begin by introducing both of them, and then this will be sort of a discussion, debate, not really a debate, but a discussion and between our two main guests. I will intercede with some pointed questions every once in a while, but mostly we just want to know their opinion and their views on the matter in question. So our first guest is Carim Habib, who is a managing partner and founder of Dolat Capital, a regulated investment advisor based in Lisbon, Portugal. Formerly an investment banker, Carim spent 15 years at Deutsche Bank AG in London. Most recently served as director in the Global Markets Division. Previously, Carim was director at ING Investment Management, running alternative investments unit for Southern Europe. He holds an MSc in Applied Mathematics from the University of Lisbon and a degree in finance from the ISCTE IUL. Carim completed an advanced derivatives program from DePaul University in Chicago, and he is a chartered alternative investment analyst, CAIA Association. Thank you, Carim, for joining us. I apologize for my voice today, but I'm having a little allergy attack, so my apologies. Our next guest is a good friend, Arthur Guimarães, who happens to be the Chief Operating Officer of UC Investments. He keeps the university open, which is a really good thing. Arthur is Chief Operating Officer at the 170 million University of California office of the Chief Investment Office of the Regent's UC Investment. He has managed the 30 million defined contribution plan, and in 2018 was awarded the Innovation Award by Pension and Investment and the Defined Contribution Institutional Investment Association. He joined in 2014. Arthur joined UC Investments from Alberta Investment Management Corporation in Canada, where he led operations and managed a transformational technology program of change known as the AIMCO Innovations. He had more than 20 years of experience in asset management, including at Manulife Financial. Arthur is passionate about diversity and inclusion. He's a member of the Portuguese Diaspora Council, a global network appointed by the President of Portugal, and serves on the board of the Practice Space, a nonprofit with a mission of creating diverse and inclusive communities. He has also served on several education boards in both Canada and the US. Arthur holds a BBA from the Schluss School of Business at York University in Canada, where he graduated with distinction, and he has taught in the BBA and MBA programs. He has also served as an instructor for the Institute of Chartered Accountants of Ontario as a CA-CPA. Arthur is also a chartered business evaluator. Again, Arthur, thank you so much for joining us and adjusting the bridge. As I see, I had never seen anybody get a cup of coffee out of the upper deck of the Golden Gate Bridge, of the deck of the Golden Gate Bridge, but this just goes to show you're a miracle worker.
And Deolinda, just a small point in case anyone is listening in from the university. I think you said million before they have a heart attack. It's billions. So
Good.
we haven't lost.
Sorry.
We haven't lost 3 zeros. I just want to mention that.
I am so sorry. I thought yeah, it did say billions. I apologize. I am so glad it's billions, actually. I am sorry. But no kidding aside, we have some very serious questions. And I think I would like to pose the first question to both of you. And that, first of all, I would like to give you the opportunity to add anything to what I have said about each of you, since sometimes bios are not absolutely current and don't really reflect what you want to say about yourself. So should you have anything to add, please do at this point. Apparently not, except for the billions. So let's start thinking about the notion of the economy as a whole and the financial markets, and that link between the financial markets and the health of the economy, the health of the markets and the health of the economy. I think in recent years, we have seen that that is not as closely weaved as we thought it was previously. So I would like to get your opinions on that, on this particular basic question, I think. We can go in alphabetical order, and Carim, I'm sure you used to go at the beginning, but Arthur beats you.
Sure, I will go first. It's a very interesting topic. If we think to the last 18 months through COVID, we saw two very, just to share two stats. One was in mid-April, you had unemployment north of 10%. And the fiscal year, for us at the UC, we're on a fiscal year, the fiscal year return for equities between July 1st of 2020 and June 30th of 2021 was in some cases above 50%. So when we talk about financial markets versus the, let's call it the real economy, there are often significant differences. We just lived through it. And it's very real. And I think, you know, another point to think about is where they intersect, though, which is becoming more and more interesting, is that the retail investor is becoming more and more, and maybe it's the idea of, you know, they've been working from home for too long and need something else to do. But just a recent stat I read is, you know, in terms of the flow or the volume in the market, almost half of the flow are retail investors. And so these are the same people who are potentially, you know, sitting at home, whether employed or unemployed. And so they, you know, the retail investor absolutely also has an impact on the market, which may or may not be connected to the real economy. So I'll open it up for Carim.
No, absolutely. I think it's a great question, and it's a puzzle for many people to actually understand what is the differences and what are the main, why is there some kind of a disconnect between the economy and the stock market or financial markets. So first, let me give you some data, which I think is going to be useful going forward. So the US economy, as of 2020, is around 20 trillion US dollars. Okay, this is the big number. China has around 14 trillion. Germany has around 5 trillion. So the US economy as a whole, it's a 20 trillion business, let's put it this way. The S&P 500, which is an index that aggregates the 500 biggest US companies, so let's say the biggest US companies overall, has a market value of 48 trillion as of yesterday. So it's more than 2 times the economy, the US economy. So the thing is that basically the economy is the aggregate of governments, corporations, and families. So we have the production of governments and spending of governments, corporations, and families. And the financial markets, basically, it's a combination of several other, I would say, several other data, and can incorporate other economic areas that are not only linked to the US. So, for example, Apple, which is a California company, I can give another example, but let's say Apple, sells globally. So the output of Apple, it's not only in the US, but it's in China, it's in Europe, it's rest of Asia. So in theory, some people are absolutely, it's absolutely valid to have this idea of disconnect, but typically financial markets are a forward-looking view of the economy, not the opposite. So when we look at economic data, we are looking at a past data of a certain economy or a certain region. Financial markets typically tend to preview what is going to be the future. And this is the main difference. So that's why there is a main difference and a disconnect from some people between the financial markets and the economy. There are other topics that I can go through, but I would leave it at this point, these 2 data.
Thank you so much. I'm sure that was a question on most people's minds. Another thing that I think, another trend, and I think Arthur brought it up a little bit, was the retail investor. And I would like to get your opinions. Over the last 30, 35, 25 years, between there, the markets began to increase considerably. And there are several opinions about this. Some are of the opinion that this is a direct impact of the 401ks and the 403bs and the IRAs of this world, who brought into the market millions of people who would not otherwise be in the market. But I would also like to include one other little quirk, and that is the retail investor, who is now able to enter the market at home through his PC and can play roulette, basically, as in a small scale to him, but perhaps altogether a large group of small scales may not be so small. So I would like to hear your thoughts on how these 2 systems, let's say, or these 2 investor groups are affecting the markets, and in a way, how they assure the continuous growth of the markets, especially the large blocks. Thank you.
I can start now.
Sure.
So the way we see things is that at the end, there is always a retail investor. You know, if you are, let's say, a Vanguard ETF or a Vanguard fund that you are managing on behalf of other people, you are managing a pool of money on behalf of other people. Those other people at the end are typically can be retail investors. Arthur, he manages money on behalf of University of California, but at the end, there are retail investors that are actually contributing to the plans, and he has a professional team managing this money. But at the end, even if it's a government, unless if it's a autocratic government, let's not go that way, but even if it's a sovereign wealth fund of let's say a region in Europe or in the US, whatever, it's at the end there is people's money on the back of that. So I would like to make that statement first. In terms of the difference between how people operate, I think over the last, I would say 20 years, and this is something very related to I think the internet overall, is that now everything is accessible on a mobile phone, and the capital markets are more accessible. Financial products are more accessible, and it's almost like it's as easy invest in a stock or in an ETF, or in some cases even in more complex products like derivatives, options, and so on, as like paying a bill that you have from a supermarket or a utility. So it's theoretically nowadays it's very easy to make investments and to do things. And so technology opened up the possibility of retail investors that are not managing, or the money that is not managed by professionals, so by professional entities, to access the markets. And I think this is very positive. This is extremely positive, because from time to time, the objectives of the investors are not the same. A pension fund or a sovereign wealth fund or a university plan can have a goal of 5, 10, 15, 20, or 30 years or more. And eventually, some retail investors, not all of them, might have a view of 1 day, 1 week, 1 hour. And this type of, I would say, different time frames in the way people invest create opportunities, and the market, in my view, becomes sometimes more diverse and more balanced. And this is interesting, and this is a way that I believe that the markets will grow in the future. You will still have professional money management. You will have the bulk of the money basically with professional money management. But currently in the US stock market, the trading volume of retail investors accounts for around 25%, which is the highest level ever. So 25% of the daily trading volume on the US stock exchange as a whole is done by retail investors. And in this, okay, for some people might be a pool of risk, but I see that basically the economy and the financial markets opening up for more and more people. And I see this as a positive thing.
Yeah, just to add to that, I agree with Carim. I think it is very positive. I think it's now become so accessible that, honestly, I've even just started to teach my kids, and it's not hard because they have their own devices, and they can go to Yahoo Finance and other technology. I think another point, technology, Carim also mentioned that point. I think I'll say innovation and technology, not just technology. In that, the Fidelities of the world are amazing organizations, but then along came Robinhood, right? And Robinhood completely changed the game. They said, we're not going to charge anything. And it's not been without its challenges. There's always, and data security, and I think that'll be another conversation for another day. But the reality is accessibility coupled with innovation has really created interest, which I think has been very interesting to see. And without getting into too much detail, when you think about some examples, like they call them meme stocks now, whether it's AMC or GameStop, these, even some volume around some of this trading has really tested the capacity of the financial markets, if you will. And that was, I would say even 5 years ago, never thought to be possible that, these sort of cohorts of folks, driving some of these stocks would make front page news, but yet here we are. And so, and I just add one more point, that is, with accessibility also comes, low cost. And I think that's another really important point that really opens up, whether it's the retail investor, candidly, even, us as investors in our investment partners, the cost of doing these things and active management has really changed.
Thank you so much. Sort of a follow-up question to that is this whole notion of triggers and the block sells, that when the market reaches a point, there are large sells, or opposite, when it reaches a low, there are large blocks of sells. How these large buying and large selling of large portions affects or makes it more difficult for people such as yourselves to predict the market swings of the market, let's say, and to sort of chart a path forward for the long-term investment versus short-term investment, because obviously these are two different ways of planning, and you still have to consider these conditions.
Yeah, maybe I'll jump in and then hand it over to Carim. I would say anyone who can tell you they know when the market will go up or down is also fooling you, because they would be very rich and sitting on a beach. The reality is we call that market timing, and that's market timing is impossible. It's sort of our view. So we like to say that we're long-term investors. I think putting day trading aside, that's a very different sport, if you will. But obviously you'll always have an opinion on the market, whether it's expensive, whether it's inexpensive, points of entry, etc. But in terms of your question on block trading, Deolinda, candidly, that's existed forever. And for example, when us as a university go into the market and say buy S&P 500, we communicate with our partners, and they're in either what they call crossing trades, which is if someone wants to sell and we want to buy, that actually reduces the fees, or we're buying methodically. So I would say the market, particularly the US markets, are highly efficient, where that's just part of doing business.
No, absolutely. I totally agree. I think there are several different games within the big game. One game might be doing day trading or scalping, as people say sometimes in certain markets, where they try to get every small difference between two assets or the same asset, and this is one type of investing, and there is a long-term, more strategic, in opposition to more short-term trading, which typically you don't have a view specifically on the day trading of the market, but you have a view on the valuation of the assets, and this is the main thing. Moreover, and I agree with Arthur, block trading is something that existed since the 60s, you know what I mean? Or even before. It's like when two institutions at the end or more want to sell and the other wants to buy, and the guy in between, let's assume a broker or a bank, they just facilitate that transaction with a gain for everyone. So block trading is something that always has existed. Now, in terms of more algorithm trading, which is a different thing, it's not necessarily being block trading. You can do algorithm trading on small positions. Now it comes back to technology and to innovation, as Arthur said. So over the last, I would say, 15, 20 years, there's a huge development in algorithm trading. So models, mathematical models that try to predict or anticipate very short-term trends. And this can be momentum. So buying things when some assets are going up and we follow a certain trend. So this is momentum. Or on the opposite side, buying things when theoretically they are extremely cheap and you buy them at a certain discount to a certain fair value. So algorithm trading is something that it's very complex. And I think UC Berkeley has a lot of people that actually graduated from UC Berkeley. I have some friends that actually done financial mathematics at UC Berkeley, and they do algorithm trading. But that's a specific trading technique. It's an investment technique, and this is very much linked to technology, to accessibility. Now it's possible using a language like Python, doing a very simple model to track and to invest with high speed, you know what I mean? So you can send several orders to the market in a very high speed with a very low cost. And that's different. I assume it's absolutely different what Arthur does and what we do. So we are also long-term investors. We believe in valuing the assets for the long term. And also there's another theory that in the short term, the market might be inefficient in the short term. But in the long term, the theoretic value of the assets and their market value, they tend to converge. And this is what we try to play, the convergence of the market value versus the intrinsic value of a certain asset or security.
Thank you. You mentioned something which leads us to the next question, and that is particular moments or particular areas of interest. I would like to bring up a couple of things. One of them is obvious climate change. There are many companies in the market involved in one way or another in what could be called climate change. And the other are decisions such as UC Berkeley's decisions to divest from fossils. So these types of things. How does this play? Does it play? What kind of effect can we see from both issues that are important at a particular moment and become more noticeably of worldwide importance, such as climate change, and then also the divestiture of certain areas by large investment groups?
Arthur, you want to jump in on this? I think you guys might have a specific ESG policy or working on that.
Sure. Yeah, no, thank you. So our office, which is UC Investments, manages basically assets for the whole university. And Carim mentioned an interesting point at the end of the rainbow, or if you connect the dots, there's always a pensioner or an endowment or a foundation with trustees. And so when we think about fossil fuels, remembering that we are the University of California, it was a decision, and you said, Deolinda, the word divestment, which is used a lot. We never use that word, and I'll tell you why. Our view of why we made the decision to basically sell, and some people may say, well, that's very nuanced, but it was based on financial risk. We're not trying to apply a screen of morality to say our decision is more moral. It's not that at all. We view it from a financial risk perspective, meaning we believe the oil in the ground, if you will, is a stranded asset. And so as the stranded asset risk of that investment, if you will, is going to be worth less in the future than it is today. Now, some of you may say, wait a minute, look at the price of oil today. And that's true. So over time, oil of all commodities is oil goes up, oil goes down, and there's many sort of shocks and factors to that. And you may ask us, well, have you turned around and bought, oil or gas or pipelines? And the answer is no. So we believe that, and as a long-term investor, that the financial risk of holding, oil and gas, coal, et cetera, is not a winning proposition. And over time, what we've found since we've started to do this is if you take our policy index, which think of how we're evaluated is called the index. It's called the MSCI ACWI. So think of it as a public equity worldwide index. You can have one with fossil fuels and one without. To date, the one without fossil fuels has actually outperformed. And so that has been very interesting for us to watch. But it's not only just buying and selling shares, if you will, that make an impact. It's also, when we talk about ESG, we also talk, so the G, everybody thinks about the E, which is environment, but the G is the governance side. And the governance side is equally important because as an owner of, not quite $100 billion of equity, but well on the way, we have an obligation to vote those shares in accordance with our beliefs. So if we didn't vote on behalf of the university to say, whether it's climate, whether it's diversity on boards, and surprisingly, and you'll just read more and more about this in the press, if you have like-minded investors and typically obviously large ones that are speaking up about the same issue, you get the attentions of the companies. So it's not just about buying or selling that particular equity. It's about, candidly engaging with them where they're open to it. And it's been interesting to read the press coming out of COP26 as well, in terms of some companies starting to make some statements. So I'll stop there, but I would say, our CIO likes to make it very simple for everybody to understand, to say, if there are only two companies in the world, one was Apple, which we've talked about earlier, and the other one was Saudi Aramco, which is basically the Saudi Arabia oil company. Which one would you buy? It'd be kind of nice to have a poll of the 20 people or so. I'm going to guess, and I could be wrong, but I'm going to guess most would vote for Apple. And there's not necessarily anything wrong with Saudi Aramco per se, but if you only had that choice, we and the markets have borne this out in terms of Apple's performance, whether it's technology, innovation, et cetera, have really, the returns have favored technology. And I know it's not that simple, but it's a simple example.
No, I think those points are really excellent. I'm going to touch on a different side of the question, just to be a bit more diversified, is that financial markets will help governments and corporations in order to finance, to finance, let's say, the energy transition globally. So governments now are issuing green bonds, so bonds that will only, or the proceeds of those bonds will be used to do the transition in certain countries. Corporations now are doing more and more the same thing. So electrical companies, even oil companies now are issuing green bonds to facilitate the transition in order to reduce the financial risk of an asset that will be stranded in the future. So they will anticipate that. Apologies. And so I believe that this is not a trend. This is something that it's happening now, and it's happening faster and with more strength. We've now witnessed COP26, which was a huge event. Unfortunately, as President Biden and former President Obama said, China and Russia did not attend. It was a bit of a surprise, or not a total surprise. but the thing is, companies and financial managers and I would say asset management companies and pension funds will actually facilitate the transition of I would say energy and other topics that I think that are really relevant, like governance, because currently there are a lot of government issues, not only in developed markets like the US, Europe, and so forth, but also in emerging markets. And this is why China, for example, or Chinese stocks, or stocks that are listed in Hong Kong, they trade at a lower valuation versus US and European stocks, meaning that the governance that those corporates have is not exactly this, they are not at par versus the European or the US competitors. So investors now are looking into that as well, not only the pension funds and the foundations and the endowments, but overall investors. And in terms of I would say going forward, this is not a theme. This is something that it's going to be compulsory. Every institution will look into that before making investments.
I would now like to direct us a little bit to the two markets that you geographically are placed in. And we would like to understand a little better what are the differences and similarities regarding rules, modus operandi, let's say, of the European market versus the US market?
Okay, I can jump in. So in terms of the stock, so the US stock market or the US capital markets, it's a huge industry, and it has the advantage of being just one country. In Europe, in the European Union, we have 27 countries. So we have several currencies, we have several languages, we have several governments, we have several legislations, and so it's a bit more complex in terms of, and this reflects in the capital markets size, okay? But then there are other, I would say, more historical issues that we believe that brings the difference between the European and the US markets in general. The first thing is that in Europe, there are a lot of companies that have a government ownership. In the US, it doesn't happen. Look, I remember in 2008, I was working back then in a bank, and I remember that all the banks or the major US banks were nationalized, and very quickly, after a couple of years or 3 years, all of them repaid to the US government, and they didn't want to be in a situation where the owner was the government. In Europe, it's actually very common for every country to have certain ownership of listed companies, and this is a difference. The other thing, which I think it's a very specific thing, is that the European companies, and I'm talking about the stock market and European listed companies, are more controlled by their founding families. So, and this is sometimes due to the fact that in Europe, there is a very high inheritance tax. So families don't want to pass their assets to the next generation, so they keep the assets. And in the US, this does not happen as often. And the business, when it's not family owned, tends to be more professional. Okay, so this brings more, I would say, professionalism to the US stock market. And the final thing, which is a bit more of a technical thing related to the previous one, is that it's very common in European markets to have what is called a dual share voting. So dual share voting brings differences between, actually some US companies have that, like Nike has that, and I think Google has that as well. There are other companies as well. But in Europe, there are many companies that have a dual share voting. This means that some votes are, I would say, more relevant than others. So you are the shareholder of a company, but you cannot decide on some decisions that are being done on the company. So this is just, in a nutshell, a few differences. What's the reflection of that? The reflection of that is that, in general, the European stock market, in my view, it's less developed. It's less, I would say, it's less deep, and it's more complex for European companies to get financing from the financial markets. In the US, this market is much more open, much more competitive, and that's why everyone that creates a company now, even in Europe, they want to list their company in the US instead of listing in Europe. Okay, this is a huge difference. Okay, and I'm going to stop here, but there are many other
excellent points. In fact, Carim's last point was the one I was going to make, is listing requirements, obviously between Europe, even, we've kind of read about this in China, but specifically, I think Carim is right, is there's just a desire. And I think, not to bring the old topic of retail investment back, but there's just this natural hunger and drive of the retail investor, given all the reasons we talked about, to invest. And so it's not that the European retail investor is not as important or doing that, but it's truly, whether it's, 25, on some days it's 30, some days I've seen it up to 50. There's so much drive and there's so much also what we call sort of dry powder. What dry powder means is really, there's a lot of money even on the sidelines, which have driven this, unprecedented stock market rise, particularly globally fair, but particularly in the US. And I think the only other point I would make that, also reflecting on ESG, when I think about European companies and particularly the public companies, but this is a more general statement, is on topics of ESG, the Europeans have led the way. I mean, and they've done that for a long time. And so I feel like, in America, we're certainly catching up fast. And obviously, particularly in California, climate is a significant issue. So is diversity, equity, inclusion. But, the Europeans have been doing this for a long time. Deolinda, I'm happy, Duarte put a question. I'm happy to address that question unless you want to wait for later.
Yeah, I would like to wait a little bit until we open to those questions. I have one final question for the two of you, and that's virtual currencies. How could we not talk about virtual currencies? So what about virtual currencies?
Well, I can start. I think this is. Can I just go a bit back and explain how a currency works? Okay, so basically, this is a very interesting topic. Currently, the international monetary system is based on the post Second World War of Bretton Woods Accord. Okay, and with Bretton Woods Accord, the dollar was the main currency of the system because all the European countries were bankrupt. They didn't have financing capability, and the dollar was the center of the system in order to create something stable for the countries to get financing and the corporations to get financing and create actually a monetary system. And on that system, the dollar was the center of the system. All the other currencies were around, like the Deutsche Mark, the French franc, the British pound, the Portuguese escudo at that time. It doesn't matter. But the dollar was based on there was a collateral on the dollar, which was gold. So when the Federal Reserve issued dollars, they had to have the same amount of gold to back that issuance. So, and this is considered to be a hard currency because there is a hard asset supporting the issue of a currency. And then in 1971, actually on the 15th of August, Mr. Nixon, who was the president back then of the US, in order to finance the Vietnam War. I know that many people now are very young, I don't know, but in 1971, the US wanted to have more financing, the government needed more financing, and they were constrained by the amount of gold that the US had. So Mr. Nixon, with their advisors, with the support of their advisors, decided to finish what was called the gold window. So the dollar could be issued without any backing of gold. And at that time, I think 1 ounce of gold was at $71, if my memory is correct. I was born at that time, but I've studied this many times. So in 1971, it was around $71, I think. And now 1 ounce of gold is trading at around $1,900. So there was a depreciation of the dollar of around 98% in 50 years. So why? Because governments don't have any limitation to issue paper. These currencies now are considered to be fiat currencies. Fiat, it's a Roman or a Latin word, which means trust. At the end, it's trust. The people trust in the central bank that they will make good of the payment, okay? But there isn't any backing. If everyone now goes to their bank and wants to withdraw dollars, probably there isn't enough dollars in the system. But the system believes that it's Mr. Powell or his successor will make good of that promise, okay? Now, virtual currencies that came about, I think it was in 2008, come to the concept of the excessive monetary expansion being done globally over the last, let's say, 50 years, but more and more since the great financial crisis of 2008, 2009, where all the governments are pumping money into the system. So virtual currencies, let's talk about Bitcoin, is basically on that concept that the issuance of a certain currency like this one is limited in time. So in 2140, there is not going to be any issuance of new Bitcoins. So they are going to be stopped in 2140 because the algorithm does not allow the issuance of new Bitcoins past that date. Okay, so it's going to be a limited amount of supply of Bitcoins. Okay, and this is the basis why a currency or a virtual currency or a digital currency like Bitcoin is appreciating that much. This is one of the reasons. It's not the only reason, but it basically is related to the fact that all the currencies in the world are fiat currencies. This is the one thing. The other thing is obviously technology, the facility of making payments, the efficiency of making payments. But the big question now is that going forward for the digital currencies, in our view, is this question. A currency needs to have certain purposes, okay, and a few strong points. And the first point is that it's stability of pricing. If you have a currency that fluctuates 10% every day, this is not a stable currency, right? It's like I don't know if you guys remember this, but in the 80s, even in Portugal, inflation was very high, and then the currency depreciated very quickly. And this is not a stable currency. So Bitcoin cannot be a stable currency while maintaining this type of, let's say, volatility, going up 2%, 3%, 8%. The other thing is a store of value. Can Bitcoin be a stable store of value for the long term? And that probably is something that digital currency might have, because at the end it has a limited supply, so it's not going to be issued by a central bank. And the other thing is that the technology behind it, it's open, so no one controls that, and that can be considered a store of value itself. And I'm going to stop here because it's a different discussion as a whole.
So I think that was an amazing explanation, Carim. Thank you. I actually learned so much from listening to you. I'll just add one more point. I agree with everything Carim said. The reason why, if you're wondering, even does the university do that, is, when Elon Musk gets on Twitter and sends a tweet and the price goes, sideways, that's sort of the other thing that concerns us. And Carim mentioned volatility is it's still, unclear as to, from a valuation perspective, how you really get your head around it as something with a stable value. But I'll stop there, and hopefully we can open up for questions.
Yes, I would like to do that at this point. And you saw, Arthur, there's a question for you in the chat. Yes. Would you be so kind as to address it?
Absolutely. So the short answer, and I'll expand a little bit, is we would.
So could you please reiterate the question for those who didn't get a chance to see it? I'd appreciate it.
So the question was, for some reason, if the tech companies slow down and oil companies become more and more appetizing in terms of investment, will he, I guess he meant sort of the broader university, reconsider investing in oil, given that we don't do that? So, and the other part of the question says a green agenda. So I would say we don't take a step back. We view it as a financial risk. So there's no agenda here. It's not a morality conversation. We believe that the financial risk of owning oil and gas, whether it's today, whether it's 5 years from now, whether it's 10 years from now, is the same. The price will go up, the price will go down. In Carim's part, when we talked about this, the transition to that cleaner economy is happening. and nothing will stop it, even though there continues to be reliance on coal, maybe less in the United States, but in many developing countries still. So the short answer is absolutely not. The longer answer is that also when you think about who we are as the University of California and the impact of climate, particularly on our state, whether we're talking about wildfires in particular and drought, and I would argue we have among we have amazing faculty in the Portuguese program, but among the greatest climate researchers on the planet. And so for us, the research is clear, and it's not about demand and supply, whether they're pumping more oil or not. We are committed to this for the long run.
So we have a little bit of time, just a few more minutes, and I would like to bring us back to perhaps the two countries that were not at the table at the climate summit, Russia and China, particularly China, being that there are two large markets in China, the Hong Kong market and the Peking market, let's say more. I'm oversimplifying. How dangerous are these markets? Are they dangerous? Is there a possibility of the Hong Kong market becoming sort of enveloped into the Peking market? What are we talking about here with these two large markets, shall we say? I don't know how large, you will tell me.
It's up to you. We can.
I would just say this and then hand it over to Carim. Focusing the conversation on Russia, on China, leaving Russia out of this for a second, given the size of the economy, and when you actually look at some of the indices, like the one I described, the MSCI ACWI, its pro rata representation, if you will, is much smaller than one arguably it could be. And so that was, if you asked me 2 years ago or asked our office, it was something we were thinking about. How do you play China and how do you overweight versus underweight? I think it's become much more complicated when you think about even on all the news, all these, them defaulting on debt payments, potentially defaulting on debt payments. It's in our view very opaque to understand. Think about another industry there, the education for profit, how that basically went from hero almost to zero. And so it's very complicated, and even in our office, there's an active debate just trying to understand what it all means. So I think the geopolitical tensions are one thing. I think the financial markets are becoming increasingly more difficult to understand and invest in.
No, absolutely. I think this is a multi-million-dollar question. I think this is a very hard question to answer because I think China has changed massively over the last 2 years. We thought the United States had changed, but then I think China has changed massively over the last 2 years. And regulation in China, and I would say the intervention of China, of the Chinese officials and government policies into the stock market, it's something that is very opaque, as Arthur said. So it's very hard to grasp nowadays what is the risk of investing in China. Because in the past, we had Hong Kong, which was like some kind of a safe harbor that the Chinese would not touch and would let the system work as it was working previously over the last 40 years. But nowadays, it's a bit more interconnected. So the Chinese are actually, or the Chinese government is doing a significant intervention in several sectors. As Arthur said, education, for example, it was a sector that was a hero and now it has almost no value. It has been nationalized, or it has been the licenses have been revoked. So this is what we call political risk, because it's something that it's difficult grasp and to put a number on. Having said that, it's a $14 trillion economy, so you cannot simply say that I won't invest and I won't look at it. But currently, there is some kind of there are a number of risks that need to be addressed before someone invests in China, and one of the risks is the political risk. And further on, I think there is another link to this, and it's not China-US relations directly, but indirectly, it's related to Taiwan, because Taiwan until now was also a very interesting market. They have the largest chip company in the world. It's called TSMC, Taiwan Semiconductor Corporation. It is twice the size of Intel, the US company. They have a fantastic technology. Like everything that we do, we use chips of TSMC and other industries. And now, because of the risk of China doing something in Taiwan, those corporates and those markets are also being affected. You see, so there is a second derivative or a second order risk of China and Taiwan linking to the US. I hope this was not very long, but so nowadays it's not like 2 years ago or 3 years ago where everyone was investing in China. Now people are being more and more careful on assessing risks.
Thank you. Those were wonderful answers. We're almost up, but I would like us to take one last question from the chat. And the question is, excuse me, do you feel like the philanthropy aspect, much more present in the US society compared with Portugal, has made an impact in how US organizations, including universities, have engaged with stock market and other financial products? And I would presume maybe Arthur would be better equipped, but I sure would also welcome Carim's response.
And then Carim also works with endowments. So I would say, absolutely. I mean, when you think about some of the wealth, that's been generated from these technology companies, particularly in my part of the world, and B, the stock market. There's been a lot of, particularly at the UC, amazing, generous donors. Whether David Geffen is just one example at UCLA, which has really created incredible sort of structures. Another one is Li Kai-shing at Berkeley. But B, you're right. I mean, it's allowed us to work with some of those foundations and actually create products that work for them. And I'll give a very simple example because I know we're running out of time. But we have what we call the general endowment pool, which is just looks like an endowment. But we also have recently created a new product called the Blue and Gold, which allows foundations, campuses, any others to take more equity risk if they feel that's what they want to take from a risk reward perspective. So I think it's absolutely provided that opportunity.
Well, the only thing that I should say is that I think Portugal should follow the example of the US, and actually I think those types of incentives and programs and partnerships are much more developed in the US than in Europe. I think this is something that we should learn a lot and follow some of the best practices here in Portugal with philanthropy and universities, organizations, and so on. I think there is a huge opportunity set to grasp.
Thank you so much to both of you. This has been an enlightening discussion. Many of our questions have been answered that we've been wondering about for a long time. I know both of you have very tight schedules, and we are very, very grateful here at the Center for Portuguese Studies for your agreeing to participate in this debate. I look forward to maybe continuing the discussion over a nice cup of coffee, perhaps in Lisbon or perhaps in San Francisco or at Berkeley. But definitely this was an immense pleasure, and I am extremely grateful.
Thank you. It was my pleasure being here.
Yeah, thank you. Absolutely. It's we're all part of the UC family, and Carim is now an
That's
honorary
correct.
member, so welcome to
Perfect.
Thanks.
Go Bears.
Go Bears, Viva Portugal. We're all good.
Exatamente. Thank
Thank
you
you.
so
All
much.
right,
Have a
thank you,
wonderful
everyone.
lunch, Arthur, and a great dinner, Corinne.
Thanks.
Bye-bye.
Thanks.
Thank you.